When every factory, port, and ledger depends on a chain that spans continents, who is truly in control? In 2025, the era of smooth, just-in-time logistics is over. Instead, we face geopolitical fault lines, cyber threats, and climate shocks, all converging on supply chain infrastructure. Recent modeling by the OECD suggests that aggressive reshoring or sourcing shifts could reduce global trade by more than 18% and cut real global GDP by over 5%. This video explains where the pressure is highest and why ignoring it is no longer an option. For decades, the narrative was efficiency. Sourcing raw materials here, manufacturing there, shipping finished goods globally. But starting with the pandemic and the 2022 to 2023 shipping crisis, the cracks widened. The world realized that delays, labor shortages, and bottlenecks were more than nuisance. They were systemic vulnerabilities. According to the World Bank Global Supply Chain Stress Index, container shipping disruptions remain at historically elevated levels in early 2025. Today, supply chains are no longer features of trade, they are fault lines of modern commerce. By mid-2025, three trends collided: rising tariffs and trade policy volatility, mounting climate events disrupting shipping and logistics, and a surge in cyber attacks targeting logistics infrastructure. One consultancy found that in the previous year, 76% of shipping customers experienced operation-delaying disruptions. These were not isolated incidents. For firms used to optimization, this convergence meant supply chains were now in the hot seat, not as providers of certainty, but as sources of risk. Our analytical framework identifies three key dynamics at play within the landscape of 2025: geopolitics, technology, and finance. Geopolitics. Trade routes, manufacturing bases, and sourcing strategies are being reshaped by national security thinking. According to logistics data, when tariffs spiked during the 2018 trade war, spot freight rates increased by over 70% on shipments from China to the US West Coast. Technology. Digital tools are now essential, but even here the gap is steep. By 2025, more than half of companies face disruption due to climate or geostrategic events. Yet only 45% of supply chain professionals believe their data architecture is fully resilient. Finance. Supply chain decisions are now board-level and capital-intensive. The cost of supply chain disruption averages around $1.5 million per day for large manufacturers. The chain is no longer operational. It carries strategic value and cost. In sum, supply chains are no longer background logistics. They are frontline assets of strategy, security, and economic resilience. As the world grapples with a landscape of uncertainty, three plausible futures emerge for supply chains. Baseline future. Adaptive resilience. Firms accept a higher baseline cost for stability. Nearshoring and inventory buffers grow slowly. Supply disruptions occur but are contained. Growth continues, albeit at lower margin levels. Acceleration future. Strategic realignment. Governments and corporations invest heavily in diversified sourcing, digital twins, supply chain visibility platforms, and strategic logistics corridors. Corporations shift from cost-centric to resilience-centric models. By late decade, the balance of power in global supply chains begins to shift. Disruption future. Systemic shockwave. A major cyber attack, port shutdown, or geopolitical blockade cascades through global trade. Inventory buffers fail, production stops, inflation surges. The world enters a prolonged period of supply chain uncertainty and structural reordering. Each path signals a different set of winners, losers, and strategic realignments. Three structural risks loom. Over-reliance risk. A narrow geographic base or single supplier network amplifies any disruption. Visibility risk. Without full real-time insight, firms cannot respond to cascading failures, yet many networks remain opaque. cost stability mismatch risk. Redesigning logistics for resilience often increases cost and reduces flexibility. Overcorrection may reduce trade more than disruption. Remember, the OECD modeling warned that rapid reshoring may shrink global trade by 18%. For industry and policy leaders, the message is stark. This is not a logistics challenge, it is an economic strategy challenge. In 2025, high-tech, energy, defense and consumer markets all depend on supply systems that span oceans, politics, and cyberspace. The key question is not if supply chains will break, but who decides which ones survive. Will the future belong to those who optimize cost or those who build resilience? If strategy, history, economics, and finance shape the world, this is where they converge. Subscribe now and join the conversation.